Libby, would you like to respond to anything on the housing front that you just heard that maybe kind of changed the way you're thinking about what could come next, what happens to home prices, what happens to Fannie and Freddie? Welcome.
Yeah, thanks so much, Kelly. Yeah, I mean, I think, like the director said, I mean, we anticipated that Fannie and Freddie would likely be using their balance sheet in order to buy more. Of course, they've already bought around $65 billion of mortgages over the past 5 months. So in some ways, we were expecting them to do that. $200 billion is obviously very significant. I think there's still some questions about over what time period. But as you said, there are some caps. The cap of their balance sheets, $450 billion. Now they're around $250 billion. So if they exceed that $200 billion, there would have to be some actions by FHFA and Treasury. Of course, during the financial crisis, or pre-financial crisis, those balance sheets looked like they were $1.5 trillion. So there is still a lot of room for them to be more involved. I think, though, that something that's quite interesting is around what the director said about going public. And I think our view would be that this does make going public maybe a little bit more difficult.
Right.
More in that if they're public, FHFA, the regulator, Director Pulte oversees, it just has less power. So they can, they're more hamstrung in terms of actually using Fannie and Freddie to advance policy goals if they are public.
Exactly.
So I think we would say this kind of complicates that.
And that is self-evidently true. However, if they do not go public and there are losses stemming from, I can't imagine, some market moves, housing prices, I don't know, economic moves, recession, and there are losses, would this not leave taxpayers on the hook again, a la, not to the same degree, but is that, do you think, why the effort to kind of, we want them to go public, we want investors to bear these losses, not taxpayers, or maybe I'm overthinking it?
I think there are a couple of things. One is just the mortgages that are being originated are high quality. So this is not a question of sort of this, adding these real subprime, sort of credit impaired mortgages to the balance sheet. So that, so that I think is quite important. The other is that these GSEs are very profitable, and all of those profits are, effectively going to the taxpayer right now. So yes, they may be a bit more on the hook if these balance sheets expand, particularly if they expand to the size pre-GFC, which we don't see happening. But also just keep in mind that they're pretty symmetrical right now, and that taxpayers are actually receiving the benefits, unlike if they were public, where those benefits would be going to shareholders.
True that. So we kind of broaden out and go, okay, well, while this is all working, and I'm surprised the mortgage rate went below 6% that quickly. I mean, I think that if it stays there, and I don't know what all goes into that, but that Americans will go, wow, okay, maybe that makes buying a house on the margin a little bit more attractive. I mean, do you think it's going to have a big impact?
Yeah, I mean, we already think, our view is that this would go under 6. Obviously, you're seeing that, today. I think the open question is, what does the Fed do here? Of course, the Fed is effectively a seller of mortgages, just passively letting these mortgages roll off their balance sheet. So does the Fed change their policy? Not necessarily by kind of, buying actively mortgages, but just making sure that mortgage exposure stays constant, which effectively would be buying.
Right.
And so that means, so that change plus this would, we think, lead to a materially, lower mortgage rate. So I think that's the open question. The Fed Governor Myron last night did suggest that the Fed could look at this. Mm-hmm. Does this make sense to just continue to allow this MBS to roll off, or maybe just stabilize it?